Okay, so today is August 4th of 2025, and let's go over the stock market tumbles that happened last Friday when the July jobs report came out. And today's Monday, and the stock market actually rallied today. So, what does this July jobs report really mean for you and the economy? Let's dive into it in this video right here. So, before I do, quickly want to introduce myself. My name is Hayato. I manage and own a real estate fund. I've personally done over 250 plus transactions, and with my partners, we've closed more than 1,000 plus deals in the past 10 years. I have nothing to sell you, and everything I share is going to be grounded in real world investing that I've experienced and not theories. And for this, and I like to look at what the economy is doing at the moment so I can make good investment decisions for myself and for my partners and also for our investors alike. So let's just break down the latest market chaos following the July jobs report and what it really signals for the rest of 2025. So Friday sell-off, the sell America trade rate turns. And after the July jobs report, that was posted, they posted 76,000 new jobs, which sounds pretty good, but it was actually less than half of what was expected. They thought at least 100,000 new jobs were actually going to come up. However, it was 76,000. It was forecasted to be closer to 170 or so. And so on Friday last week, the S&P 500 plunged nearly 2% on Friday, August 1st. And what happens was the traders immediately pulled capital out of US equities and the dollar, and they moved it into bonds and gold. And the rotation return of what they call sell America trade, last seen during peak recession fears in early 2023. And so why the panic? The downward job revisions was a major impact. And yes, the July jobs were lower than what was expected, but the biggest thing actually that came out of that report wasn't what happened in July, but was the revisions that happened for May and June. And so May and June jobs were cut by a combined 215,000 jobs, and not cut in a sense that all those jobs were taken away. It was revised that those job growth actually wasn't the real numbers. They were saying that May and June, the job growths were around 100,000 plus. However, it turns out it was closer to around 10,000. So it was a significantly lower number than what was expected and what they actually published before. And so seeing that, Trump actually fired the labor commissioner. And so that was another huge ordeal. So all of these different things reduced the stock market prices on Friday and caused a sell-off then. And unemployment also ticked up to 4.2% as well. And hiring momentum, therefore, showed that it slowed dramatically across multiple sectors. And in the July report, it showed that the only industry that really grew in terms of the job market was the healthcare industry. Everything else, including manufacturing, which was supposed to go up because of what Trump is doing with tariffs and whatnot, still lost jobs there. So that's what we're looking like at the moment. And today on Monday, we saw that the rate cut hopes took over. And so what does that mean? Today in the market, the mood shifted a little bit, and investors began betting that the Fed will be forced to cut rates sooner than expected. And so traders are now pricing in 2 rate cuts before the Q2 of 2026, with the first potentially landing in December of 2025. And because of that, the stock market actually rallied a little bit today. And so bond yields dropped, growth in tech stocks bounced back quite a bit, and the S&P 500 recovered nearly all of Friday's losses, which is quite surprising. And according to Bloomberg, this is now a classic case of bad news is good news. Soft labor data is being spun into Fed optimism so that they can lower rates and they can go ahead and make the economy move a little bit more frictionless and efficiently now. So what does this really mean, and why is that risky? So this kind of reaction shows how fragile confidence is in the market, because a simple thing like that on Friday, actually, it's not very simple, right? It's quite a big thing. Job growth is the fundamental unit metric that we take a look at to figure out whether or not the economy is growing because the job growths are a significant part of that. And on Friday, weak jobs data sparked that panic. On Monday, the same data then fueled optimism. So it's the same data. Nothing's changed in terms of data, but the market reacted completely differently when the bad news came out and when optimism kicked in on Monday. So underneath the surface, the signals are clear though. Job creation is slowing. It is a fact. Revisions are frequent and it was quite significant. And layoffs are rising in some key sectors. And so these are facts. And so relying on the Fed to prop up the market every time we see weakness, in my opinion, is quite a dangerous game. And as an investor, I always tell people don't build your strategy around wishful thinking or optimism or rate cut hope. You have to build it around fundamentals. Otherwise, you are going to get hit hard and you won't know what came at you. And if you're looking for the government or the Fed to ease up whatever project you're going into and you're underwriting for that, there's a good chance that those things don't happen. And again, it can hurt you in the long run. So that's why I believe it's quite risky based on what we're seeing in the market and the optimism that we're seeing. So if people are continuously underwriting optimistically, again, it can hurt those investors moving forward. Just my opinion. Now, in terms of the volatility driving investors towards real assets, what I'm seeing is when the stock market gets quite volatile and unpredictable like this, a lot of people also start to look at real assets like real estate for stability. So unlike equities, which can swing wildly based on macro news or Fed expectations, real estate tends to be a little bit more stable over the short term, cash flowing if bought correctly, and that is a major important part of real estate too. So whether the market goes up or down, there's many ways to go about it and pivot as long as you have a good fundamental asset underneath your belt. And so that's why it's really important to buy well, especially when you're going into real estate. And another part of it is that it's inflation hedged in many cases. So with housing demand strong and rent staying sticky, it's no surprise that investors are moving capital towards real estate as a risk mitigation strategy, especially in high population, economically diverse cities. Real estate continues to offer an attractive alternative to the volatility of stocks. So I think a lot of people are going to be moving some of their capital outside of the stock market and maybe moving it into assets like real estate or anything else to hedge against their risk. So what do you think? Was Friday's panic justified and are Monday's gains premature? Or do you think the Fed will actually cut rates in 2025 and then the optimism is justified? What are your thoughts? Drop them in the comments and let me know how you're preparing. And if you appreciate these breakdowns, hit like, subscribe for more data-backed updates. I'll see you on the next video.